Right, so this week, guys, I've got something a little bit interesting for you, a little bit different as well. This was alerted, we were alerted in the Discord about this one. So Martin Lewis was going to talk on his show on ITV about investing, which is quite interesting because it's something he doesn't normally do. Before we've said some of the answers he's given to people was sort of semi-dubious. So I thought I would test the questions that he got asked. I would offer them to you guys to offer your opinion on. And then I'll tell you what Martin said, and we'll see if you guys think he was correct or not. So feel free to chime in. But I'll go to Steve first. We'll see what he thinks. Some of them are really simple. Some of them are a little bit trickier, but nothing that you guys should struggle with. So Steve, we'll start with you. Here, the first question was, what are the key differences between a fixed rate ISA and a stocks and shares ISA?
Oh, fun. So we're bringing back all the old favourites then. We've got a game on this week's show. Martin, who is? Right. So what are the key differences between a fixed rate ISA, presumably a cash ISA, and a stocks and shares ISA?
That's correct. Yeah.
I guess the key difference is that a fixed rate ISA is closer to having a guaranteed return. I think strictly it's not a guaranteed return unless your bank is covered by a FSCS or something like that, and the government agrees to bail it out if it goes bust. So theoretically the entire bank could bust, basically, in which case you probably wouldn't get a guaranteed return. But a fixed rate ISA tells you a number, and that number is what the bank, I think, is, or building society, is kind of contractually obliged to pay you. With a stocks and shares ISA, you buy something that represents probably an ownership in some sort of business, although I suppose you could buy commodities instead. And you, in virtue of owning shares or some cross-section of something, get a variable return depending on what that business does and what other people are prepared to pay for a share of that business. I bet he didn't say that. He had something snappier, right?
He would have said something.
Do you want to chime in, Paul, before I say?
Yeah, he would have said something like, would he have gone as far as saying one's a guaranteed return, one's a very risky return, and one locks up your money for a ridiculous amount of time versus one you can choose to take it out whenever you want. But both are tax-free. That would be probably what he says.
So he said that he wants to get you out of the mentality of his old saying, which is interest in an ISA is nicer, apparently. But he did go and say that stocks and shares ISA is investment. Essentially, you're putting your money in the hope that it will increase. You have to take the risk that you might lose some of your money, or worst case, all of your money that you put in. A stocks and shares ISA, it differs in that it's about your attitude to risk. That was what he said.
Fair enough.
I think that's probably pretty fair, to be honest.
Pretty fair, yeah.
It's a bit too basic.
I think you might... well, this is... Remember, it is a basic show. This is for people who are only exploring ISAs or stocks and shares.
This is ITV
Here you go, Paul.
prime time.
Second question. Is now a good time to invest in a stocks and shares ISA?
Oh, okay. The answer is no. There is no good time to invest in a stocks and shares ISA because you don't know where the market is going to go. That is the answer.
No. Yeah, it started off right, but I think you lost your way a little bit. So I was with you on no, there is no good time to invest in a stocks and shares ISA because interest in an ISA is nicer. Like I've got on 250 T-shirts now that I've been having printed.
So he said no one knows, even though he does have a crystal ball. He said no one knows. If you are looking to invest, you must have a 5-year timeline, but now is as good a time as any. Simple as that.
Yeah.
Next question was, what are the main benefits of a stocks and shares ISA? Go on, Steve.
The main benefits of a stocks and shares ISA is that they, over long periods of time, outperform fixed rate or cash ISAs.
Paul?
Tax-free benefits, and dividends rain from the sky.
That was it. He basically said No tax on income, no tax on gains, no tax on dividends, no capital gains on selling, and then he clarified the rules on capital gains. So fairly straightforward. I think I would say Martin Lewis is 3 out of 3 here.
Yeah, very reasonable.
So Martin said it's such an uncertain time in the market. So he had a CFA as well, so he was also asking the CFA questions. He said it's such an uncertain time in the market. Shouldn't people be worried about shoving your money into an ISA and it going down? Isn't that a problem? Would it be easier for people to drip feed instead? What do you think about that?
I don't like that he's saying that it's about shoving money into a stocks and shares ISA, right? He's not. It's too simplistic because he's saying, oh, it just goes in the ISA and that's what it is. It automatically buys stocks and shares. No, you've got to consider the index fund that you're going to buy, or the mutual fund that you're going to buy, or the individual stock you're going to buy. I think it's a little bit simplistic to me, but yeah, I mean, what can you say? The market is really uncertain. I think it's really uncertain all of the time, and there's no good time to invest in the market, right?
Well, they gave an interesting scenario where they said about putting £12,000 into the market and just doing it £1,000 a month, because they said that would smooth out the ups and downs that you would experience in the market. And I think I agree with that, and I also kind of don't agree to that. You're not really smoothing anything out. You're just putting in money if it goes up and putting money if it goes down. It's more sort of like calendarized depositing. But yeah, it was an interesting topic. He deferred to the IFA. He deferred to the IFA a couple of times, and here's one of the times he did. And this was a stinker. So, what is a sensible overall charge for investing in terms of what the fees should be? I've been quoted 2.7% for the first year. But in subsequent years, it drops down to 1.77%. Is this okay?
Well, as I understand it, the kind of standard-ish hedge fund thing is something like 2% of the total amount and 20% of profits or something like that. So the numbers are around that level. But I think probably Martin Lewis, or whoever was answering this on behalf of Martin Lewis, is going to point out that there are lower cost index funds than that, right? Than trying to get someone to pick fees for you. So I'm going to guess he said the correct number is something like around 0.5%, maybe.
So Martin Lewis actually scoffed at this. He thought it was very high indeed. But the IFA, who I can only surmise worked for St James's Place, tried to sell it as saying, typically you do pay higher fees in the first year when you're setting up, and if somebody is actively managing it, then that's a fairly fair amount to pay. I sort of disagree with that. But actually Martin Lewis chimed in and said he still thinks it's too high, and asked her, would it not be more beneficial to use an ETF?
Yes.
She then started talking about how ETFs have charges of 0.25 to 0.5. She said that the fees maybe seem quite high, but you should expect to pay 1.5%. They then went on to what an active fund and what a tracker was. But to be fair, I think Martin came out of that one pretty well. I think he got all of that.
He's done well then.
Pretty right.
But he's done well there. But
yeah, so
maybe because obviously, if you get a fund advisor to do this for you, they charge you an extra 1.5% on top. So maybe that's what this guy's talking about. He may be sitting down and saying that, yeah, well, because I've seen a lot of people that I know, right, who have gone to a financial advisor and said, we'll set you up with this product. And they've set it up with the product and they've come to me, because they've heard that I do a little bit of investing, and they go, look, this guy just sorted it all out for me. And I look at it and I go, what's the charge? And they say 2.5%. And I was like, okay. And I look through it. Oh my God, it's just 5 index funds. That's all they've done. They've gone into Legal and General, and then they've set them up with 5 index funds. And I went, oh my God, they're charging you 2.5% for you to go, which you could have done just by yourself. So that's something I thought they might talk about there, but they didn't. And that's why I worry about Martin Lewis, even though he's done very well there to say, actually, he's gone, that's too high. But some of the independent financial advisors aren't so independent. Is that worth saying?
No, that's fair enough, I think. Yeah, they have to be whole of market, don't they? That if they're not whole of market, they tend to just be good at selling products. But
that is true, yeah.
So the next question they asked was, if people are interested in investing, should they be speaking to people like you? Obviously turning to the IFA again. He said, be honest, do I need a decent wedge to talk to you to make it worthwhile, to make it worth the fees? If so, how much money do we need to speak to you? Any thoughts on that?
Well, that's just talked about exactly what I've talked about, right? That's just something very similar. They will say no, it's not expensive, and they'll send out something like a 2.5% fee, and you really see the reality of what some of these financial advisors are doing. They are. I feel like they're scamming people for what is quite a basic bit of knowledge that they could find on YouTube. Sorry, this has been a big bugbear of mine for quite a while now. Sorry.
I feel like if only there was a platform where people could just buy ETFs with no dealing fees and no ISA fees and no account fees. So the only fees they would pay would be, the ones from the ETFs themselves. Anyway, not this week, but I feel like that's the kind of thing. I'm always suspicious, like Paul, when someone asks a question on a TV show and prefixes it with the words "be honest." I sort of feel like I didn't realise there was a question about being honest here until you brought it up. But my instinct is that they're going to say they need something like 1,000.
Yeah, but the fact is that he's saying be honest, which actually this is a test of Martin Lewis. He's actually doing pretty well, right? By saying be honest. Come on.
Well, to be fair, he pressed her for an answer here, and she sort of agreed on needing tens of thousands before you should really start to speak to her, which obviously, with the sort of audience that Martin Lewis had on that show at that time, it felt like that was quite high. It sort of put her a bit aloof for the audience, I would say. But Martin went on to say, look, there's plenty of ways to do this yourself. He recommended that you would use Interactive Investor, which was bizarre. I think that's one of the smaller of our set of brokers, I would guess, but it's not the one that normally gets touted as the one forward. He also mentioned trying Fool.co.uk, which was interesting to hear that Martin Lewis is interested in Motley Fool and Steve's work. But if you have a large whack and this is your life... Yeah, but if you have a large whack and this is your life savings, he thinks you should go to financial advisor, not just for investment advice, for all the tax side of it too. But I'll give you the last one anyway. The last one in the pile was from Diane, and she said, my stocks and shares investment is controlled by my building society. It is decreasing in value. Should I cash in or should I hope they pick up?
I would suggest... sorry, am I supposed to be saying what I think Martin Lewis would do, or am I supposed to be saying what I think I would do? Okay, so here's what I think Diane should do. And one of the things that I don't know about Diane is obviously her age, but more generally her kind of what other money she has elsewhere and so on. But my instinct is that if Diane can possibly help it, she didn't ought to cash this in. One reason being that we always say on this show that when things are going down in value, it gets very tempting to sort of panic and sell, but panicking is not a good idea because panicking is a bad idea, basically. It doesn't matter kind of what age you are. But if you're tempted to sell, I suppose we kind of are attentive to the thought that you often miss the best few days in the market just after a downturn, so things can look better sort of quite quickly. Even in bear markets, you get quite savage rallies, so I would urge Diane to not be shaken out by this, knowing the very little that I know about her situation.
Also, it's completely detached from her building society, isn't it? That seems like a red herring.
Well, this was what they picked up on as well. So Martin Lewis said, well, you only lose money when you sell. And then he passed it to the IFA, who said that the key thing with investing is that you have to stay strong. You have to take the ups and the downs. But in this case, she thought it was worth looking at what other options are available out there, which she said it sounds very restrictive as to what they're potentially invested in, which is a strange one. I don't really know how she got that from. It was a tweet, this as well. It wasn't a person. So she told her that you'd have to bear in mind that you're crystallising a loss. Martin agreed oddly and then told her to have a look at getting some discounted fees from some do-it-yourself brokers, which again, felt like that is potentially good advice, but it is very situational, and you don't know whether Diane is interested in stocks or knows anything about stocks, or whether she's just given it to some kind of managed account. So I would give him only half a mark for that, but out of the rest of it, I thought he did pretty well. Would it have got people interested in investing? Not really. I think it was too basic. They didn't go for an IFA to sit there and not go over the basics of what the S&P has done, or historical, or to even talk about ETFs in any great stretch. Was a real miss on primetime TV, I thought, but they tried.
I thought that was pretty good, especially the kind of Martin Lewis bit of it.
Yeah, I think but Martin Lewis has done a lot of justice there. I do think that Diane needs to go to 2 minutes 48 of last week's show and answer the question and get because I don't think she'd be able to go into and invest, sign up to Trading 212, sign up to Hargreaves Lansdown, sign up to Vanguard and buy a broad-based index fund. I don't think she'd be able to do that and continue investing on her entire horizon without a book like The Psychology of Money, which develops a lot of people's behavioral finance terms, which is what we are, which is what Diane would be lacking. She doesn't understand that bit of it, and therefore she's likely to lose money in the market by doing it herself. And I don't know if 2 or 5% from a financial advisor does get you a better behavioral finance, because I think they just act on instruction. But there's something wrong there. Behavioral finance wins in the entire system here, I think, and maybe Martin Lewis could have talked about that a little bit more, or maybe pushed that a little bit more. And yeah, that's all I've really got. But yeah, 9 out of 10, definitely.
Yeah, it's not that kind of show, so I think he was never going to go into that. But I think there was a missed opportunity there to get some education across the line. But I think Martin Lewis is pretty happy peddling his savings accounts and high rate savings account. And hey, he's in his element at the moment when prices of things are rising and savings rates are as attractive as they are. He looked really good yesterday, comparing rates, savings rates, and everything for people. Not such a well-oiled show. His earpiece kept falling out, and he kept trying to pick it up off the floor, which is not good in a live show. But yeah.